Namaste and welcome. I am Pratim Ranjan Bose and you are listening to my podcast Perspective. In this episode, I will share my views on India's outstanding growth run vis-a-vis economic crisis in China and why this year's US presidential election is crucial for both economies. India has done it again. The country clocked 8.4% growth in gross domestic product or GDP in October-December quarter. This is nearly 2 percentage points higher than the forecast by independent agencies. The government-owned State Bank of India's Economic Research Wing projected 6.8% GDP growth in the December quarter. India's growth trend continues to be robust in the January-March quarter. As of February 2024, manufacturing activity was at a 5-month high. Tax collections were 12% higher, railway freight increased by 10%, and car sales jumped by 11%. It is now almost certain that India will end the financial year 2023-2024 with a GDP growth of 7.6%. This is higher than the government's expectation of 7.3% and the Reserve Bank of India's expectation of 7%. The World Bank and the International Monetary Fund (IMF) expected India to grow at around 6.5% in 23-24. To sum up, India is not only the fastest growing major economy in the world. No other country in the post-COVID world has been beating growth estimates so consistently. In a recent article, Prosenjit K. Basu, former chief economist for India and Southeast Asia at Credit Suisse First Boston, predicted that 7.5% growth became a new normal for India. The article was published in the Times of India on December 25, 2023. The robust performance strengthened the demand for upgrading India's sovereign credit ratings. Agencies like S&P Global, Fitch, and Moody's place India at the lowest investment grade of BBB minus or equivalent. Are they justified in doing so to the fifth largest economy in the world that is all set to be the third largest in 2 years? Global investors have already started treating India more respectfully. A top state-owned bank recently raised debt from the global market at rates that justify a country rating of AAA minus. In January, Reuters reported a rush of foreign portfolio investors to buy India's long-term government bonds ahead of its inclusion in the benchmark index. On the contrary, the Financial Times reported waning interest of dealers in long-term bonds of the UK. Clearly, global investors have more faith in the Indian story than the rating agencies. India's stock market is reflecting the investors' confidence. Over the last 5 years, the benchmark Nifty 50 increased by 100%. The growth has been 55% over the last 3 years and 22% over the last year. The situation is strikingly different in China. Since 2021, China's CSI 300 benchmark stock index declined by nearly 42%. The decline has been a sharp 19% in the last 12 months. All global indices relating to Chinese stocks suffered. Overall, nearly 7 trillion investors' wealth is eroded worldwide. This amount is equivalent to the combined GDP of Japan and Germany. The market crash has hit China hard. The public issue market has dried up, startups are starving for cash, investors in Wall Street are now turning to India and other Asian markets for recovery. The entire debt pile of $13 trillion became bad or doubtful. According to Kyle Bass, founder of the Dallas-based hedge fund Heyman Capital, China is in for a crisis which is 3.5 times bigger in terms of banking leverage than the subprime crisis in the US in 2008. In an interview to CNBC, Bass said the years of double-digit growth that China enjoyed before the pandemic were made possible by an unregulated real estate market, which leaned too heavily on debt to expand. With 70% of household savings directed to real estate, the trouble has shaken the very foundation of the Chinese economy. China's growth miracle is over, said Ruchi Sharma, head of Rockefeller Capital Management's international business. The Indian economy is nowhere near China in size and depth. However, the trouble in China has surely improved India's chances of attracting foreign direct investment or FDI. India is now attracting roughly 50 to 55 billion FDI a year. This is similar to the FDI flow to China 20 years ago. With robust growth and strong government in place, India should attract more FDI in the next 5 years. The FDI graph may witness a sharper upswing if Donald Trump comes to power in the US in 2024. Trump has promised to increase the tariff wall against China. According to London-based advisory firm Capital Economics, another round of tariffs may accelerate the shift of production out of China. Assuming Trump wins, we can safely assume a good share of the production exiting China will land in India. As an Indian, I would love to see that happening. Thank you for listening to Perspective. If you like this episode, please share and subscribe. See you next week. फिर मिलेंगे.